Hey everybody, it's Miss Morgan and we're going to talk about unearned revenue. To teach this concept, I talk about a concert example in class. You are going to produce a concert. And the reason you're going to produce a concert, of course, is to earn revenue, to make money. Okay, but in order to produce the concert, you have to secure a venue and the band to get on their calendar, right? So it's going to cost you some money up front. Therefore, you decide to set up a Ticketmaster account and a PayPal account so people can purchase tickets ahead of time. Well, when you get that money, you're going to debit cash. So let's say you got $10,000. Well, you've got to decide where to put it. And that $10,000 is a debit to cash because we got more cash. But are we going to put it here in concert revenue? Or are we going to put it here in unearned concert revenue? Well, according to the accrual basis of accounting, we cannot consider it revenue until the money has been earned. And the money won't be earned until the concert actually happens. So we're going to put that money here in an account called unearned concert revenue. Now, unearned concert revenue is a liability. It's going to show up on your balance sheet. You need to be able to understand this and explain this. If someone says, hey, here's $10,000 worth of revenue on your balance sheet, you can say, nope, I haven't earned it yet, and it's not revenue, it's a liability. In this case, what do you owe these people? Well, you owe them a concert. Now, as soon as the concert happens, you'll take the money out of unearned and put it into concert revenue. Our next example is rent. Let's say that you own a building and you put up a for rent sign. Okay, you find a customer. They're going to pay you $10,000 for a 6-month lease. So you debit cash for $10,000. Here's our debit to cash, of course, because we got more cash. But we can't put it in rent revenue. Why not? Because we will not have earned our money until we've allowed them to use our building for 6 months. Okay, so we're going to call this unearned rent revenue. So we'll credit the account unearned rent revenue for $10,000. Now at the end of the year, we always look at our prepaids and unearneds to make sure that we make the correct adjustments. And so at the end of the year, have we earned any money? Well, absolutely, because the month of October, November, and December, we have allowed that customer to use our building. So half of this money, $5,000, has been earned. So we will debit unearned rent revenue for $5,000. Half of that, $10,000, and we'll credit rent revenue for $5,000. Oops, $5,000. Rent revenue is a revenue account, and that will go on our income statement. Unearned rent revenue is a liability, and you see here when we close out this T account or balance out this T account, we still have $5,000 on our books as a liability. Why? Because they're going to use our building for 3 more months. So this is our liability and this is our revenue.